Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. And on this episode, we're going to discuss the challenge behind the AI boom. As well, we'll take a look at earnings season start strong and U.S. stocks and foreign stock returns converge. And we'll venture on over to the Plan Solutions Incorporated office bulletin board as well. Mr. Armour, how are you, good sir?
Doing well. Enjoying the post-tax season slow down a little bit, and catching up on some projects and things that pushed off until things slowed down.
All right, let's dive in here around the challenge behind the AI boom. Artificial intelligence, a hot button topic. We've talked a lot about it recently. I've had questions I've thrown out to you around where does the actual monetization come beyond business to business type stuff? So really great topic to dive into. Where do you want to start around this and the AI investment boom?
Yeah, so Matt actually wrote this article, and I thought it was a really good insight. There's been so much buzz around the AI investment boom, right? And just the amount of money that is going into investing in these multiple iterations of these large language models, and of course the compute and everything that has to be built out behind that. And of course, with that much investment, it just creates higher and higher expectations, and there's challenges that come with that. Obviously, we're still at the phase where most of the work is being funded by outside investment, right? Investors are putting it in. We are seeing sales increase at some of the leading AI companies, but they're still not anywhere near sufficient to fund the continued investment needs for the continued growth. Obviously, the goal is that eventually the revenue will grow to not only meet the needs for reinvested capital, but to exceed it, right? Which is where then the profits and cash flow would be generated to pay back the investors for all of the money that they've put into it. And with the amount of money that's gone into it, you start kind of taking a step back and saying, okay, just what is that going to take, right? In terms of the level of sales to, not just be able to make these companies self-funding, where they're not so dependent on outside investment and, needing to raise round after round of additional investment. But, what will it take for them to become, not just self-sufficient, but actually, generating that return on investment that no doubt investors are expecting with the billions and billions that are being invested.
Yeah, absolutely. And I think one of the interesting areas, and I'm glad that Matt really pointed this out, is, of course, AI, a powerful tool, a lot of optimism. But we forget while we're on our personal computer, whatever that may look like, or maybe even using it on our mobile devices, the amount of power that actually goes into the calculator, so to speak, the data centers that house all this. Takes an extreme amount of cooling, very high end, hard drives, et cetera, et cetera. And I think that that's part of one of the areas that people leave out when this discussion happens.
Yeah. When you think of AI, you kind of think of it as software, right? As computer code. And of course, historically, the SaaS, the software as a service industry, it's been very scalable, because once that code is written, it could be copied infinite times or accessed infinite times without very marginal additional costs. But what we're seeing with these, with the AI is, it's not just the software, it's the physical infrastructure that's required, right? For these, to build out these data centers. And like you said, with, the energy requirements and the cooling and just the clear, size of these data centers, right? With all of the rack servers, et cetera, that are in there. And so it may be that there are actual constraints that we didn't necessarily see to such a degree with the internet or the software as a service industry that really boomed, where those constraints could be, just the normal constraints that would affect a physical, business with physical assets, right? Or that needs talent, like the limitation of construction workers, electricians, engineers, cybersecurity experts, cooling system technicians, all of those things that will be required to really support the end game for where AI is going. And that could be the point where it really runs into growth constraints, and potentially even higher amounts of investment needed to completely build out. And the question is, where's that going to come from, right? Are there enough investment dollars and enough potential end return to justify that? Or will these companies be able to generate enough revenue to be self-sustaining and continuing to make those investments in the physical infrastructure, but also, the human resources and the people and the training that will be required?
Yeah, I think, as well, obviously, infrastructure, and I'll be more specific when it comes to power because these centers use a tremendous amount of power. Uh, and with the growth around this, they're also incorporating, and Matt was very thorough in his writing here around the digital twins, which are virtual models of data centers. So, there's a lot of infrastructure aspects that are coming into this. There's been discussions, obviously, around the country about, adding more energy plants as prices rise to hopefully lower the cost in the long term and so on. So there's a lot of factors just beyond the initial company itself that are coming into play.
Yeah, and some of the, what you'd almost have thought of 5 years ago as sci-fi type stuff, right? I mean, these small modular nuclear reactors they're talking about putting data centers in space where you don't get the degradation of the power of the sun, being reflected by the atmosphere. I mean, that's the type of direction that these AI leaders are having to think, right? When they anticipate the type of power that they need. But obviously we're moving into, areas of the realm of almost science fiction in terms of things that haven't been done, haven't been tested. And will that work, right? Or what will the overall cost be? And will the eventual revenues be there to justify, that type of, research and development to determine if these things are even viable, and then the implementation could be extremely costly.
Yeah, I mean, let's run down some of those factors. Obviously, we're talking about the factories and everything else, but even in the United States, building data centers is still a difficult challenge because we need skilled workers to do this. And it's the irony of the argument is always, well, this AI, it's going to take away skilled workers. And the problem is, no, we're actually having a challenge getting skilled workers to be able to come in to build these data centers and support the infrastructure of the companies themselves.
Yeah, I mean, I think it's kind of the irony, right? A lot of old line businesses, are looking at, okay, we have access to workers, but how do we pay them enough to retain them, right? And to keep them happy and motivated. And in the AI industry, it's almost the opposite. They have so much investment coming in, they can pay workers huge amounts, but it's how do we find enough workers? And I mean, anecdotally, a lot of what you read is those who are working in that industry, they're working such long hours and under so much stress because really there's not enough of them. They're being paid very well, but they're still in some cases leaving the industry because they want that better work-life balance. You can only put in that many hours under that type of stress and work, only so quick that eventually you just become burned out. So yeah, it's kind of the irony that AI is not seeing the financial constraints, but they're just seeing the literal constraints of not enough people with the skills, which is something that may or may not be impacted fairly quickly. Years ago it was the advice to everybody going to college was learn to code,
Yeah.
right? And now everybody's saying, well, that was the worst advice we could have given you because AI is doing most of the coding, and the coders that do continue to be employed will be so much more efficient. Being one person being able to replace do the job of five with the help of these AI models. Now it's shifting to, learn to be an electrician, learn to, deal with some of these other specialties. But, those are kind of on the job type skills. There's not really college programs or trade programs designed around this at this point. So a lot of it has to be on the job training, which of course means, initially those people are not going to be very efficient.
Yeah. I will follow up here that's been dancing in my mind since we started talking about this is do you think that with what Matt shared here, it really sparked for me is, that there was a lot of the perception that this was going to be a short-term investment with a big-term gain, and it just doesn't seem to be playing out this way.
Yeah, I think that's my takeaway, and I think that's the takeaway of history when you look at similar type booms. There's always an expectation that it's going to happen a lot faster than it will because some of these constraints are not taken into account or at least not completely priced in the way they should. And so as we've talked about in past podcasts, what ends up happening doesn't mean the technology doesn't continue to advance and have uses and transform society as we've seen with the internet or a lot of other past innovations. It just takes longer than people realize because of these constraints and of course in the world of finance that based on time value of money, the timing matters. Cash flow today is worth a lot more than a dollar of cash flow in the future. And so if the expected high growth rates and revenue targets and things like that have to be extended because of these challenges, then that means those investments are not worth as much as what people may as the value that people may be assigning to them today.
Yes, sir. All right, let's jump to earnings season starts strong. Hey, this is a good sign. Obviously, there's a lot of geopolitical uncertainty going on right now that's been impacting the market over the last 2 months. But hey, we've got some positive signs happening.
Yeah, I thought a client put it well the other day. Said the market almost seems bipolar, and I thought actually that's a great point. There are kind of two poles, right? One trying to pull it down, and the other one trying to pull it up. Obviously, the geopolitical events and the challenges there that continue, continues to be a risk, and pulled the market down earlier in the year. And I think high prices of gasoline and things, persisting are continuing to try to pull the market down. But on the other hand, over the long term, corporate earnings tend to be the largest determinant of stock market values. And if we look at where that is at, we're about 50% of the way through earnings season. The S&P 500 at this point is projected to earn $70.10 for the quarter, which would be a 10.35% increase from the fourth quarter and a 21.51% increase from the same quarter a year ago, basically year over year, which is pretty substantial earnings growth. And so you can understand why we've seen some strong rebound in the market despite some of the continued risks because investors are responding to the key metric that they normally look at, which is strong sales growth, strong earnings growth, strong cash flow growth, really a continuation of the strong trends that we saw coming into this year.
Yeah, it's an interesting reflection of growth for sure. I mean, what with everything going on, is there any projection around third quarter and what that may look like within the year based upon this, as your client said, a little bipolarness?
Yeah. That'll be the interesting thing. I mean, the S&P 500, if this continues, will post three straight quarters of 20% plus year over year earnings growth, which is really strong, probably on its own, not sustainable over the long term, right? You'd expect to see that slow to maybe a more sustainable rate. Um, but I think it will be interesting. One, we still have 50% roughly of companies to report. So it'll be interesting to see if those hold up and those projections continue to remain as high as they are. Two, earnings reports by their nature are backward looking. So
Mm.
we're looking backward at a quarter where it started out really strong and we really didn't have these geopolitical risks, higher energy prices, some of the negatives really didn't occur till closer to the end of the quarter. So maybe they're not being entirely reflected here. So it will be interesting to see once earnings season is over and investors maybe, stop looking backwards to some degree, but start looking forward if they start to, price in some of these negative pressures or the impact that they may have, or if you just, you stop having the drumbeat of optimistic or positive earnings reports each day, but, continue to get news about, potential risks or shortages or challenges or supply chain issues, if that will, kind of change the investor psychology as we head into the second quarter, before we get back into earnings season.
Yes, sir. Absolutely. Anything else you want to add before we jump to U.S. stocks and foreign stock returns converge?
Well, just from our perspective, kind of that bipolar comment. I mean, the risks and opportunities do seem very balanced, right? At this point, if there was to be some resolution or reduction in some of the risks, you could see the market respond very positively. On the other hand, if those risks should increase, or maybe we see some weakness in some of the positives like earnings or some of the other positive economic data, I think you could see the market move the other direction. So it's a really challenging scenario where you don't necessarily want to reduce risk because you could miss out on some positive returns if a more optimistic scenario plays out. But on the other hand, you don't necessarily want to be taking on a lot of risk, because if the more pessimistic scenario plays out, obviously that could work out badly.
Yes, sir. All right, U.S. stocks and foreign stock returns converge. We talked about this on a previous episode, how foreign stocks outperformed U.S. stocks in 2025 for the first time in many years. The trend was also evident during the start of 2026 as the dollar continued its decline and foreign stocks surged ahead, actually posting a 7.7% increase to the S&P 500. But we're seeing kind of a shift of that happening here in the first part of the year.
Yeah, it's been interesting. It seemed like we were seeing a really strong environment benefiting foreign stocks, which have offered better valuations for quite some time, right? I mean, makes sense. They haven't gone up as much as U.S. stocks in the past, so they looked more attractively priced. And we started to see a shift of that in 2025 with the strong performance, and that, of course, was aided by a decline in the U.S. dollar. And so, for the first time in quite a while, we saw the dollar decline from really what were historically very high levels.
Hmm.
And so it gave up some of that strength, and but still arguably probably would have a ways to go, right? Just to get back into a normal range or following a normal cycle. So it seemed like things were really benefiting foreign stocks. But then with the war in Iran, the increase in energy prices, we've seen a shift. We've seen the strong outperformance of the foreign stock index has really converged with U.S. stocks, right? So as you said, the foreign stock index was up 7.7% after 2 months compared to 0.5% for the S&P 500, right? So really strong outperformance. But if we look at it now, the foreign stock index still up 5.8%, so solid rate of return, but that's compared to 4.8% for the S&P 500. So both came down, and then as the recovery happened, U.S. stocks recovered much stronger than foreign stocks, and they're now getting a closer in terms of the rate of return, which maybe is a sign that strong period of foreign outperformance, maybe is coming to an end because of some of these geopolitical factors.
Yeah, absolutely. And as shared here in the personal financial review, that many foreign economies are most likely going to struggle a little bit more under higher oil prices than the U.S. economy, because there is a big misconception about this, that the fact is the U.S. is energy independent. And what we mean by that is that the U.S. actually exports as much oil as it imports. Which is a very interesting scenario. Whereas some other countries, they don't have that. They're not oil producing on any level.
Right. Yeah. A lot of countries in Europe and a number of countries in Asia are pretty much entirely dependent on imports, right? They may have nuclear, they may have some renewables, but oil still continues to be a key energy input for a lot of industries, and a lot of these countries really don't have any reserves to speak of. So those higher oil prices really impact them more. At least in the US, with higher oil prices, are going to benefit the US energy companies. So we're going to see that within the US indexes, a portion of the market benefiting. And also because a lot of it is produced here, lower transportation costs, et cetera. So yeah, it really seems to be reflected, that the U.S. is in a much stronger position in terms of energy policy than a number of other countries, and especially, some in Europe and even to an extent like Japan, where they've moved away from nuclear in recent years, counting on other sources and thought, okay, in a kind of normal, peacetime environment, they'd be able to backfill that through trade or other agreements. But with the Russian invasion of Ukraine, now with the closure of the Strait of Hormuz, right, that's kind of putting them in a bind because some of their domestic production, electricity production's down. They're relying more on natural gas, and that's becoming just harder to access.
Yeah, absolutely. Anything else you want to add before we jump to the Plan Solutions Incorporated Office Bulletin Board?
Well, just that I think this is a trend we're going to have to watch carefully, right? Again, we kind of talked about the optimistic scenario, the pessimistic scenario. I think that will have an impact on the U.S. markets, but probably even more so on foreign markets. So, yeah, that'll continue to be a key factor, especially when looking at the mix of U.S. versus foreign stock allocations.
All right. Well, let's dive on over to the Plan Solutions Incorporated Office Bulletin Board. Two items pinned up there this week. Yourself, Shannon, Joel, and Daryl got out and played in a golf tournament recently.
Yeah, like I said, tax season's over. We tried to schedule some kind of fun things to do, after tax season, so we had something to look forward to. And yeah, there was a charity. They provide activities for teens with mental development, disorders. So, good local charity where the money stays in the community, and we like supporting those. So they also put on a great tournament. It was a great day, nice golf course. So I had a lot of fun. I wouldn't say we played our best, but we did a good job in the putting tournament. Helped to raise some money for a good cause, and of course Shannon, is always the lucky one. Multiple years in a row now, walking away with a raffle prize. So I think we're gonna have to push him to buy a lot more tickets next year to make sure to come out even, in terms of the amount he's donating and all the prizes he's been taking away.
Yes, sir. What's the second item pinned up there? It seems that Carter and Matt have been active as well.
Yeah, so they survived their first tax season. They got through it and they did a good job. So, as a reward, we've promoted them from that shared office in the back. When we brought them in, we thought we want them in a shared office. They can learn from each other. They can support each other, kind of we're in this together. Let's work together type of environment. And I think that worked out well. But, as they're continuing to develop, we moved them closer to the front of the office and into their own offices. So they now have a window, right? They've been promoted to a window or earned a window, which is nice. But also it'll help us, it'll make it a little easier to have more people up front. So if clients drop in, it'll be a little bit easier to hear that front door if Michelle or Caitlin happen to be away from their desk or working in the back compiling paperwork or something like that.
Yes, sir. All right. I love it. Anything else you want to add while we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, like I said, we're finishing up with a lot of different projects and things. So, and continuing to do a lot of tax planning out of last year's tax season. So, it's a great time to kind of level set things, that now that things are slowing down, they tend to get a little quiet in our office over the summer, which is nice. I know probably a lot of clients on vacation or in the nice weather thinking they want to do something besides review their investment portfolios. But But this is also a great time to, really think about that longer term planning, retirement, that type of thing. So if people have any questions or some things they want to look at, by all means, feel free to reach out.
Yes, sir. And all the information on Plan Solutions is in the podcast description. So if you want to just inquire there, go to the website, make a phone call. It's all there and available to you. And we want to thank you for listening to the podcast. Please hit that subscribe button if it's your first time. And please share with someone else you think will get value out of the podcast. We don't do any external advertising of the podcast. It's all word of mouth. So we know that our growth in the podcast comes from you, and we appreciate it. And if you want to subscribe to the Personal Financial Review, the written content that Chase and I discuss here on the podcast, it's easy to do so. All you got to do is send Katie an email, that's KATIE @plansolutions.com, and let her know you want to subscribe to the Personal Financial Review today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.